Guys, I have an investment opportunity for you. You are gonna give me $8,000, and then 1 year later, I'm gonna give you $1,760 back. Sounds like a crappy deal, right? Well, if somebody tells you to hold on to your mortgage for the tax write-off, that's the deal they're trying to get you to make. If you have ever told somebody that you're trying to pay off your mortgage early, I can almost guarantee you they told you this. Well, you need to keep your mortgage for the tax write-off, right? What's up, guys? Welcome back. My name's Brad. I make videos with tips and motivation on how to get out of debt, how to stay positive, and how to live a happy, more fulfilled life. If that sounds like something that might be for you, please consider subscribing, hit that bell notification so you get notified every time I upload a video or I go live. Today, I want to talk about a slightly controversial topic, which includes paying off your mortgage early. Full disclaimer, I am not a mortgage expert, but I am a numbers expert, and the numbers in this case, for me, don't lie. All I'm doing is presenting information. I am not going to tell you what you should do. I'm just telling you what I'm going to do and why. And you, as an intelligent person, you can make your own decisions after that. So the thing we're going to talk about here is, should I keep my mortgage because the interest that it accrues is a tax write-off? Yes. You can write off the interest on your mortgage at the end of the year as a tax deduction. First and foremost, though, what we need to remember is that we have to know what the difference between a tax deduction is. It's a tax deduction, it's not a tax refund. Meaning if you pay $10,000 in interest towards your mortgage, you're not going to get that interest back. That's the framework of this myth and how we're going to debunk it. I'm going to show you exactly a hypothetical situation where the numbers won't lie. People really can't argue against these numbers. You're not getting a tax refund. You are going to get a certain amount of your income decreased according to the interest that you pay. Let's take a look at a couple situations and see if I make any sense in this case. When filing your taxes, you have two options. You can take the standard deduction, which right now for 2018 just got almost doubled to $24,000 if you are married, and if you're single, $12,000. That means you don't have to worry about anything. You're gonna have $24,000 be taken off your income right from Jump Street. On the opposition to that, there is something called an itemized deduction, where you can take certain itemized things like interest, like student loan interest, like charities, a loss, a fire. There's a couple different that you can look up. You could take the sum of those, and if they are more than the standard deduction, you could use those items to deduct from your income. Fun fact. Roughly 2/3 of Americans last year took the standard deduction in 2017, and since they doubled the standard deduction for 2018, that number is only going to go up. So first and foremost, if you're taking the standard deduction, then your mortgage interest has no bearing on this conversation whatsoever, because you can't do both. You can't take the standard deduction and itemize your taxes at the same time. So ask your accountant, do I itemize or do I take the standard deduction? And if your accountant says, oh no, you take the standard deduction, well, then having a mortgage, that interest, this point is over right there. But now let's say you do itemize. If I don't have a mortgage, Tara and Brad, they make $100,000, okay? And what that does right now is that puts them in the 22% tax bracket. Now, those brackets might change when you're watching this video. They might be a little different, but the numbers won't lie. So if I don't have a mortgage, okay, and I make $100,000 and I owe 22%, that means I am going to pay $22,000 in taxes. There will be nothing I can do about that. Taxes are like death. They are certain. All right, so being in that 22% tax bracket, I make $100,000, that's going to be it. But now let's say I have a mortgage and I'm gonna itemize my deduction. I have a $200,000 mortgage at 4% interest. That interest will accrue and I will pay roughly $8,000 in interest on that mortgage, which will become my tax write-off. But how much does that $8,000 really get you in the long run as a write-off? How much tax return dollars will you get back for that? Well, what happens is you take that $8,000 in interest and you take it off of your gross income. So now, instead of Brad and Tara having a $100,000 salary on paper, they only have a $92,000 salary on paper. Their salary was decreased by $8,000. Which keeps them, in this case, at the 22% tax bracket. Now, you might be thinking to yourself, well, what if it changed your tax bracket? Guys, tax brackets is another misconception. I made a video on how tax brackets actually work. I'll post it up in the eye in the sky. But you will see that that doesn't really make a difference. But in this case, I'm going to stay in the 22% tax bracket. Now, with that decrease in income, I only owe $20,240, which, yes, guys, that is less than the original $22,000 that I had to pay. This is that point in the year where you're thinking, hooray, I'm gonna get a tax refund of $1,760. I'm going on vacation, I'm gonna buy a new car, hooray, tax returns are great. And yes, you got $1,760 back of the money that you paid. Guys, tax returns don't come from a magical pool of money that get refunded back to you. Tax returns are money that you overpaid the government that they held on to and gave back to you at the end of the year. So let's think about that $1,760. You got $1,760 as a tax return, but you had to pay $8,000 in interest to get that $1,760 back. Now, you don't have to be good at math, but does that sound like a good investment? You just lost $6,240. Now, you're thinking to yourself, no, that can't be true, Brad. There's no way. Nobody would do that. Right now, in the United States of America, we think now. We don't think long-term, and we don't do math. We think $1,760 now. We don't think $8,000 in interest over the entire course of the year. And remember, this is only a factor if you itemize your deductions, which more than 2/3 of America don't do. If I can put it in different terms for you, how about if I tried to make this deal? You were gonna give me $8,000 on January 1st, and on December 31st, I'm gonna hand you back $1,760. Sounds like a good deal? I don't think it does. Guys, I hope this cleared up this little conversation that I know you're gonna have with people when you tell them that you're trying to pay off your mortgage early. Guys, pay your mortgage off early. 1, because most of you are gonna take the standard deduction anyway. 2, because interest sucks. If you don't believe it, take a look at this video I just posted about interest. And remember, some people you just can't have an adult conversation with. Take a deep breath, move on, stay positive, be kind, and always work hard, and you'll be just fine. Until I catch you on the next video, guys, have yourselves a great day.